The Central Bank of Nigeria, or CBN, has announced an extension of the suspension on cash deposit fees until March 2025. This decision provides relief for individuals and businesses who are bracing for the reinstatement of these charges. The move comes as the CBN continues its efforts to stabilize the financial system and promote economic growth. This extension is expected to have a significant impact on the banking sector and the economy as a whole. It reflects the CBN's commitment to creating a more conducive financial environment. The move aims to encourage investment, stimulate economic activity, and ease the financial burden on Nigerians. The CBN's decision has been met with positive reactions from various stakeholders. Individuals and businesses have expressed relief at the extension, as it provides them with more time to adjust to the evolving financial landscape. The suspension of cash deposit fees is seen as a welcome measure that will provide some breathing room. The CBN will continue to monitor the situation and make further adjustments as needed. The decision to extend the suspension on cash deposit fees comes as a welcome relief to many Nigerians. These fees, which were previously levied on deposits above a certain threshold, had been a source of contention. The suspension aims to ease the financial burden on individuals and businesses. The CBN initially suspended these fees in May 2024. This was done as part of a broader effort to mitigate the economic impact of various global challenges. The extension of this suspension underscores the CBN's commitment to supporting the Nigerian economy. The fees had been a point of contention, with some arguing that they disproportionately affected certain segments of the population. Small businesses in particular had voiced concerns about the impact of these fees on their operations. The suspension seeks to address these concerns and create a more equitable financial system. The CBN's decision to extend the suspension has been met with widespread approval. Many view it as a positive step that will help to alleviate some of the financial pressures faced by ordinary Nigerians. The move is seen as a sign that the CBN is attuned to the needs of the people. To fully grasp the significance of this extension, it's crucial to understand the origins of the policy. The roots of this policy can be traced back to the economic challenges that Nigeria has faced over the years. It's not merely about suspending fees, it's about the CBN's strategic response to a complex economic landscape. The Central Bank of Nigeria has always been at the forefront of navigating the country through turbulent economic waters. The decision to initially suspend cash deposit fees in May 2024 was not made in isolation. It was a calculated move, reflecting a deep understanding of the economic pressures at play. It was part of a broader set of measures introduced by the CBN to address emerging economic challenges. These measures were designed to create a more resilient financial system capable of withstanding shocks. These challenges included rising inflation, dwindling foreign reserves, and a depreciating currency. Each of these factors posed a significant threat to the stability of the Nigerian economy. The CBN recognized the need for proactive measures to stabilize the economy and mitigate the impact of these challenges on businesses and individuals alike. This foresight was crucial in ensuring that the economy remained on a steady path. The suspension of cash deposit fees was a strategic move aimed at encouraging deposits within the formal banking system. By doing so, the CBN aimed to bring more money into the banking sector. By making it more attractive for individuals and businesses to deposit their cash, the CBN sought to increase liquidity in the banking sector. Increased liquidity would enable banks to offer more loans and financial products. This, in turn, would provide banks with more resources to extend credit to businesses and stimulate economic activity. The ripple effect of this policy would be felt across various sectors of the economy. The policy also aimed to promote financial inclusion. Financial inclusion is a critical goal for the CBN, as it seeks to ensure that all Nigerians have access to banking services. By reducing the cost of depositing cash, the CBN hoped to incentivize more Nigerians to open and utilize bank accounts. This would help integrate more people into the formal financial system. This is particularly important in a country like Nigeria, where a significant portion of the population remains unbanked. Bringing these individuals into the banking system is essential for economic growth and development. Section 4, May 2024, a turning point. May 2024 marked a turning point in Nigeria's financial landscape. It was the month when the CBN announced the initial suspension of cash deposit fees, a decision that sent ripples throughout the economy. This move was a calculated response to a confluence of factors that were putting pressure on the Nigerian economy. Globally, economies were grappling with the aftermath of the COVID-19 pandemic. Supply chain disruptions, rising inflation, and geopolitical tensions created a volatile economic environment. Nigeria, heavily reliant on oil exports, was particularly vulnerable to these global shocks. Domestically, Nigeria was facing its own set of challenges. Inflation was soaring, eroding the purchasing power of ordinary Nigerians. The naira, Nigeria's currency, was on a downward spiral against major currencies, further fueling inflation. Against this backdrop, the CBN recognized the urgent need for interventionist policies to stabilize the economy. The suspension of cash deposit fees was one such policy. It aimed to encourage deposits, boost liquidity in the banking system, and ultimately stimulate economic activity. Section 5. Decoding the fee structure. To understand the impact of the CBN's decision, it's essential to delve into the fee structure that was in place before the suspension. This fee structure has been a topic of much debate and scrutiny over the years. For individuals, banks typically charged a fee of 1% on cash deposits exceeding 500,000 naira. This fee was applied uniformly across various banks, creating a standard that customers had to navigate. This meant that a deposit of 1 million naira would attract a fee of 5,000 naira. For many, this fee was seen as a deterrent to depositing large sums of money in banks. For corporate entities, the fee structure was even higher. These businesses often had to deal with more substantial amounts of cash, making the fees a significant part of their financial planning. Banks levied a 2% charge on cash deposits exceeding 3 million naira. This higher fee was justified by banks as necessary to cover the additional risks and costs associated with handling large cash deposits. This meant that a deposit of 5 million naira would incur a fee of 40,000 naira. For large corporations, these fees could add up quickly, impacting their overall financial strategy. These fees were a significant consideration for businesses, especially those dealing with large volumes of cash. Many businesses had to weigh the cost of these fees against the convenience and security of using banking services. The rationale behind these fees was multifaceted. Banks argued that they covered the costs associated with processing, transporting, and securing large cash deposits. This was particularly important in a country where cash transactions are still prevalent. Banks also contended that the fees encouraged customers to utilize digital banking channels, thereby reducing reliance on cash transactions. This shift towards digital banking was seen as a way to modernize the financial system and improve efficiency. They also contended that the fees encourage customers to utilize digital banking channels, thereby reducing reliance on cash transactions. Digital banking offers numerous benefits, including convenience, speed, and reduced risk of theft. However, critics argued that these fees placed an undue burden on customers, particularly small businesses and individuals operating in the informal sector. These groups often have limited access to digital banking and rely heavily on cash transactions. They contended that the fees discouraged savings and hindered financial inclusion, especially among those without easy access to digital banking. This was a significant concern in rural areas where banking infrastructure is limited. The debate over these fees highlights the broader challenges of balancing financial innovation with accessibility and fairness. As the financial landscape continues to evolve, finding solutions that work for all stakeholders remains a critical task. Section 6. Individuals and Businesses, a Tale of Two Rates. The impact of the cash deposit fees was felt differently by individuals and businesses, creating a complex financial landscape. For individuals, while the fees might have seemed insignificant for smaller deposits, they became increasingly burdensome for larger sums. This was especially true for those who relied heavily on cash transactions. This was particularly true for those in the informal sector who often dealt in cash. These traders, who formed the backbone of the local economy, found themselves at a disadvantage. Imagine a trader who had saved up 750,000 naira to purchase inventory. This amount, which represents months of hard work and savings, would be subject to a fee. Depositing this amount would mean parting with 2,500 naira in fees, a significant portion of their savings. This fee, though seemingly small, could impact their ability to restock and grow their business. This disincentivized saving within the formal banking system, pushing many towards informal savings methods. These methods, while familiar, often lack the security and benefits of formal banking. For businesses, particularly small and medium-sized enterprises, the impact of the fees was even more pronounced. These businesses, which are crucial for economic growth, faced additional financial hurdles. SMEs, often operating on tight margins, found the 2% fee on large cash deposits to be a significant financial strain. This fee could affect their cash flow and operational efficiency. This fee ate into their profits and limited their ability to reinvest in their businesses. The cost of doing business increased, making it harder for them to compete and expand. Take the example of a manufacturing SME that received a large order requiring them to purchase raw materials worth 4 million naira. This order, which could boost their business, came with its own set of challenges. Depositing this amount to pay their suppliers would mean incurring a fee of 20,000 naira. This fee, while necessary for the transaction, reduced their available capital. This added cost could be the difference between fulfilling the order and missing a business opportunity. The financial strain could hinder their growth and ability to take on new projects. In conclusion, the cash deposit fees created a challenging environment for both individuals and businesses. While intended to regulate cash flow, they inadvertently pushed many towards informal methods and strained the financial health of SMEs.